We're going to try and talk a little bit about some of the slides that you just presented and see if we can identify any interesting sort of trends or knowledge from what you're playing out there. I guess maybe top of mind, what do you think is a real valuable sort of trend versus a bullshit trend? I know you were talking about a lot of sort of surge in search terms, but I was particularly interested to hear you talk about the asset-intensive stuff. I think that's an area we're trying to pay attention to, particularly real estate tech is something that we're looking at quite a bit.
Yeah, I mean, I think the thing right now is every big corporation is worried about technology. They're either worried about or they see an opportunity with technology. And when we started the company, I think we thought our customers would be venture and tech companies. And I'd say probably in the last month, most of our subscriptions have been to insurance or CPG or retail. So everybody's worried about this. They all think that technology is going to impact them. And so they're, I think, incredibly receptive to partnering, investing, hopefully potentially acquiring these companies down the road. I think there's a lot of them are still early days and trying to get the lay of the land, and so they're not necessarily writing checks, but awareness is important.
Because I've definitely seen a huge growth in corporate VC activity and funds over the last 3-4 years. It's probably double, maybe even more than doubled.
Yeah, absolutely. There's lots of new funds. A lot of corporations do what we call the Silicon Valley petting zoo, right? So they
please do elucidate on that.
So I think there's a lot of folks who mistake innovation with, hey, we're going to come out to Silicon Valley, we're going to meet some founders who wear hoodies, and we're going to meet some VCs, and that's innovation, right? And so we see a lot of that.
The Disneyland tour.
Yeah, Disneyland petting zoo. So we see a lot of that. But then there are, that's not all corporations. And we see folks who are actually starting to write checks, whose M&A teams are starting to look at companies. It's gonna take a while for them to get around to this, but I think we're seeing more activity, and a lot of them are still in the discovery, let's do PowerPoint phase of the cycle. But hopefully some of them will go from preparing and knowing to actually doing things, and
yeah, I think recently heard a quote from Mark Andreessen that he thinks we're just about to enter the most active period for M&A over the next 6-12 months or so. Do you agree with that? Do you think that's correct?
It's hard to make those types of predictions.
It's hard to make predictions, especially about the future, Yogi Berra.
Yeah, so I think if you look at
seriously, you guys don't pick up on that?
I think if you look at the recent, you see Vista getting more acquisitive on the sort of PE buyout side, Microsoft doing this big deal. So I think, there's been a bit more activity. Twilio's IPO is going to be obviously a good harbinger of what might be coming. So I think there's good activity, but whether there's a trend here, I mean, corporates are sitting on big balance sheets. But I think Silicon Valley valuations or valuations in general have been a little disjointed from reality. So they're going to
until maybe the last 3-6 months, right?
Yeah, I think it'll. You're going to start to see those come down, and then as people get religion and people realize that maybe this company is not going to be huge, there's going to be opportunities for these companies to do big acquisitions.
But don't you think that the LinkedIn acquisition of Microsoft acquisition of LinkedIn is no coincidence? I mean, LinkedIn dropped in value in market cap about 4 months ago, literally 40% on one day. I'm sure that the Microsoft deal, Reed's no stranger to a lot of folks behind Microsoft. That deal's probably been talked about, tried for the last 3 to 4 years. It seems like it's not a coincidence that after dropping 40%, all of a sudden the price is in range and that deal gets done.
Yeah, I mean, if you like something when it's worth 100 and when it becomes 60, you probably like it more,
hey,
right? So
it's on sale, half off now for LinkedIn.
Yeah, so I mean,
what about
amazing
Twitter?
asset. We don't play in public. I mean, so I don't know. I see I see all the I see the thought leaders decrying Twitter's product a lot. So that tells me maybe something that's not good.
It's kind of crazy, right? I know revenue's not amazing, but still usage at 350 million users.
The thing I will say about Twitter, because we track their investments and acquisitions, is I really have no understanding of what the hell they're doing when it comes to corp dev and corp venture.
They just made a big acquisition, right?
Yeah, they made a big acquisition, but they invested in a headphone company. They're doing a venture fund with BetaWorks. It's kind of like, it seems like you have more pressing priorities versus throwing money into into sort of these kind of cool PR-y things. But
don't you think there's a new relationship that corporates are having with the Valley and even with other VCs? I think in the past it's been maybe seen as an adversarial relationship, and a lot of VCs here in the Valley have kind of looked down their nose at corporate activity. But it seems like maybe there's a little bit more positive perspective, and corporates are finding a place that doesn't include taking board seats, but still maybe making investments in acquisition?
Yeah, I mean, I think there's, again, it varies from VC to VC. There's the lazy, sort of intellectually lazy argument is to say that corporate VCs are dumb, right? There are smart VCs, there are dumb VCs, there are smart corporate VCs, there are dumb corporate VCs. You know, we still see, though, there's a handful of folks who are just like, oh yeah, corporates are not smart. So I think that's just the stupid sort of, you know, like a trite sort of remnant of 2000. You know, we do hear from corporates, though, that VCs send us their dogs. Right? So when you've got a deal that can't get done
if
with...
you've been invited into a deal as a corporate VC, you're probably like, why am I the dumbest guy at the table? Or
yeah, I mean, I think some corporate VCs see that. Some corporate VCs are like, ooh, like somebody in Silicon Valley sent me a deal, right? So I think that's a problem, right? There's going to be... I think corporate VCs are starting to wake up to the idea that a VC's customer is the entrepreneur and the LP, and maybe on a limited basis the corporate. And so you have to look, you know, you have to assess that, you know, just as much as you would assess any deal, irrespective of where it came from.
I think it feels like there's one new sort of story, which is because a lot of capital required, at least in the first couple of years, by startups is less significant than it has been. Founders tend to own more of the company, and it feels like the sub-$100 million acquisition is actually an opportunity for corporates. I call that sort of Series B sniping, but between an entrepreneur who's looking at a Series B deal or trying to get a Series B deal and the challenges in kind of growing a $500 million to $1 billion company versus taking the $50 million exit where they might own half the company still, that seems like, at least for a lot of first-timers, a safer game to play than, you know, trying to go huge and, you know, potentially having a big unicorn but potentially having a flame out.
Yeah, I mean, that's not really new, though, right? Like, most of the acquisitions in tech are sub 100 million.
Right, I'm just saying that because the lack of capital,
time.
The founders own more. So where that acquisition might not have been as interesting if they own 10 to 20%, now they might own 50%.
Yeah, I mean, I think, you know, they might be a little more receptive, but over many, many years, it's always been less than $100 million has been the primary sort of acquisition size. I think there's a mythology of startups where we sort of talk about the billion-dollar exits and the unicorns a lot, but, you know, the vast majority of exits are nowhere close. So,
you definitely highlighted a few crazy areas that seem to be super hot, sexy. I think, you know, AR, VR, drones, AI, choose your sexy topic of the moment, FinTech. So we're starting a FinTech fund. Sheil Manot is in the audience and raising a FinTech fund. Where's Sheil? Sheil's raising money. Go give him your money if you like FinTech. Do you think that there's too much FinTech going on?
FinTech is such a broad theme, right? So there's FinTech at the enterprise level, like people, I think there's a lot of hype around disrupting and unbundling of the bank, and there's a lot of technology that's being built that will make banks and financial services firms more efficient. But I mean, you know, you look at the insurance industry, I mean, you know, trillions of dollars of premiums, and they're just waking up to technology. You know, the user experience on the insurance side is worse than cable companies.
Like when you look at,
I mean, and that's not me saying that. That's like objective ratings, right? So it's a pretty sorry state of affairs. And so I think they're waking up to this idea, and then there's, you know, some disruptors in there, but you know, I think there's massive opportunity. Insurance is probably the area that we're most bullish on. You know, I think there's a first wave of payments.
Do you think lending is?
Lending's, you know, you have.
Some high-profile catastrophes lately.
Yeah, I mean, I think, you know, it's a tougher space, right? I think there's, you know, Ondex weathering the storm right now, but Lending Club and other folks, and, you know, Prosper and whatnot. So I think there's going to be a shakeout there. So, you know, lending, payments have kind of been done. Robo-advisors.
Payments and lending are done. Really?
I think they've just had their wave, right? I think the next wave is sort of insurance, right? When we look at robo-advisors, you know, you look at an example of where the big companies have actually fought back very successfully. Charles Schwab and Vanguard, by assets under management, are crushing Betterment and Wealthfront. And so, you know, those are two examples of corporations who've kind of got in religion and done something. But yeah, there was a little bit of overfunding. But, you know, I guess fundamentally the business models are solid. I think one of the more interesting acquisitions that we're looking at is BlackRock. I think it was BlackRock acquired Future Advisor. And so they're kind of building, in my view, sort of the AWS of robo-advising, right? So I think instead of trying to pick a winner, they've acquired this platform, and now they're like licensing it and private labeling it for wealth managers. I think that's an interesting play. We talk to a lot of corporates and we tell them, stop trying to pick winners and just try to pick a trend and then be the infrastructure layer behind that trend.
You guys have been tracking a lot of activity outside the US in Asia recently, and I think tracking sort of the rise of unicorns, particularly not just out of China, but also India and Southeast Asia.
Yeah.
I guess region by region, do you feel like that's a positive sign? China in particular, do you feel like they're on a rising, continuing tide, or do you think they're poised for some kind of revaluation or coming down to earth?
I mean, there's been less unicorn activity in China as of late. Most of it's driven, a lot of ponies, I think, and not unicorns. A lot of the China activity has been driven by corporates. Yep. And so I think, they are kind of maybe just taking a pause a little bit. But, net, there's a lot of activity there. What we see also is a lot of the Chinese investors looking to invest in the U.S.
Seems like a lot of China money is now going outside China to the U.S.
Yeah, I mean, the U.S. is still a safe, sort of harbor for lots of that money, and there's a lot of innovation here. So I think we see lots of China companies setting up outposts in the Valley or New York in particular, trying to invest in U.S. kind of innovation. So I think that trend will continue. As to what happens in China, it's a little, it's a little crazy there. I mean, we had Chinese LPs offer us money to start a fund, like unsolicited. Like that's how much money there is there.
We've seen $100 million pre-money valuations for companies that are pre-revenue, $20 million valuations, $30 million valuations for PowerPoint.
Yeah. So it's but there's there's some really interesting activity at the accelerator level. I think a lot of folks who worked in U.S. tech companies have now gone to China and are setting up operations there. So there's a lot of innovation that'll come out of there, a massive market. So
I woke up this morning to a tweet by Nikesh Arora. He recently resigned from Softbank. Literally, this happened hours ago this morning. If you actually follow his tweet stream, some pretty revealing and transparent remarks from Nikesh. I guess the story sounds like Masayoshi Son still wants to be CEO of SoftBank for quite a while, but I'm bringing this up because Nikesh came in, was hand-tapped by Masa Son to not just, have a significant portion of the operation, but run SoftBank investments largely in India, potentially be the heir apparent to take over. As part of him coming in, I believe he invested $500 million in SoftBank stock, $400 million. What do you make of him sort of stepping down or taking a step back? Does that say anything about India, or is that more SoftBank politics?
Yeah, question that's honestly above my pay grade. I think SoftBank took a very different tact in the investment side once Nikesh came on board. So they used to write smaller checks. They had SoftBank and ventures in New York.
Small checks being 10 to 20 million. Now they're doing 50 to 100.
Now they're doing massive, $500 million checks to SoFi and things. So I think there was a very different philosophy when it came to how they were going to invest. And so whether that philosophy played a part in the change of management is one thing, but speculating on why.
But don't you think that should have fairly significant implications for Indian investors to see a huge, sort of late stage investor pull out of that market or potentially pull out of that market?
Yeah, I mean, I think there's, Tiger Global's pulled back in India. A lot of the late stage money in India has taken a pause. But if SoftBank were to resume its early stage activity or early to mid stage, I think that's a net positive for India. It's just whether they get out of the investment game totally, that would be obviously bad for the market. But yeah, hopefully they'll kind of continue.
So I think you already answered this question, but maybe just to wrap up, do you feel concerns that we're in a bubble? Do you think the activity last year was too exuberant? And maybe to answer your own question, do you feel like this year is better?
Yeah, so we don't think we're in a bubble. We think a bubble is sort of characterized by two trends. It's a rapid acceleration of values and a rapid deceleration. So we have 50% of that equation has happened. There's been a rapid ascent. The rapid decline, I think, is not going to happen. In 2000 or in 2007, there was a economic or stock market kind of thing that deflated.
By real estate, right?
Yeah, that deflated sort of all these balloons at one time. I think what we're going to see here is a unicorn's going to fail here, and then a unicorn's going to fail in another 3 months. And what will happen is lots of air getting taken out of the market very slowly, and so it's not this rapid descent. And when that happens, what we see is investors basically say, "Oh yeah, those guys were stupid. I would have never done that deal," right? And so, you know, you can kind of, and then you also just bury the dead quietly, right? So that tends to happen as well.
You wrote an article, I think, earlier this year that you thought there's still 2 or 3 more quarters of unicorn revaluation or broken unicorn revaluation.
Yeah, you know, Q3 and Q4 is when most of the unicorns, I think 60% of the unicorns based on sort of history, are going to need to raise again. And so that's when we're going to see either the layoffs to extend runway, or you're going to see some asset sales or whatever. But again, like, it's happening, there's no pinprick that's going to just like pop the whole thing. It's going to happen over time.
So if anything, the press predicting the bubble over the last 3 years has kind of gradually taken the air out of whatever bubble there might have been?
Yeah, I mean, since we've started the company, people have been predicting a tech bubble, right? So, yeah, so it's kind of your earlier point. I mean, if you say it long enough, you'll eventually be right? And like, people don't remember that, right? I think somebody should start a Twitter account when anytime a company gets funded, just saying this company is going to be the next unicorn, and then delete all the tweets that don't materialize, and then just look really smart. And that's effectively, and it's not just media. I mean, people in the ecosystem have been calling this stuff for a while, and if you called it in 2012 and it pops in 2019, like, you're not good at making calls. You just, you know, wrote a blog post.
To all you investor bloggers out there, thanks for the motivation. Anand, thanks again for coming out and giving us a whirlwind tour of the state of the market.
Cool, thanks, Dave.